As you know, everyone looks at the same data. We all get the same data. The government puts it out. But different economists place different emphasis on certain variables at certain points in the cycle. And so we were watching 2 points of view based on the same data. One was we are back in the 70s environment. Inflation is baked into the cake. It's going to be very difficult to dislodge it. And we're probably in an environment where commodity prices, real estate, tangible assets generally are going to do much better than the financial markets. And so we were dealing with that scenario. And as you know, we were looking at data and actually more than a year ago anticipated a very different world. What we didn't anticipate, of course, was the extent and the length of time that we were going to see supply chain disruptions. And we certainly did not expect Russia's invasion of Ukraine. So those have been variables we've had to work through in terms of our own thinking about the future. But we did come to the same conclusion that we were probably going to see more deflationary forces at the end of all of this than inflationary forces. And I believe that we are in the early stages of seeing that. Now, these are the early stages, but Nancy's view of the world, which she every week puts into charts that really help evoke what's going on. Her view of the world was closer to this, inflation is not embedded in the system at a rate much like the 70s. The Fed is really focused on the US, but I think Europe is in a recession. China, some of the numbers coming out of China are shocking as well. That has an impact on the rest of Asia. So what they're facing is a recession, and their currencies are dropping. Their currencies are dropping relative to the dollar, which means their purchasing power is going down. But it also means that some of them are tightening more because their currencies are falling against the dollar. So it's a bit of a vicious cycle. And as Nancy says, I agree with you, Nancy, we are not alone. Many people are thinking about the U.S. in isolation. We've already had 1 quarter of negative GDP, which most people brushed aside, saying, "Oh, that's a fluke." And I think that was a real number, and we should not dismiss it. In past cycles, many people thought that the dollar going up was the same as monetary tightening. It's a disinflationary force. And it's up 15% since the bottom, which is a huge increase for the dollar in such a short period of time and really hurts emerging markets. It strikes me that that those who are listening will say, "Oh my gosh, this is terrible," and it is in one way, but one of the things we're focused on is what will get the Fed to stop tightening, or at least change its rhetoric. And I think as these forces put pressure on the economy, and you get companies like Walmart and Target reporting terrible numbers from 2 points of view, and I know Nancy is going to go into some of this, but their sales up 3% year over year, while inflation itself is up, if you looked at CPI, 8%. Now, they're not passing all of that through, but I am sure that they are passing more than 3% through. So that means their unit sales, their real sales, are declining on a year over year basis. while inventories are ballooning. And we think that those two factors, and now the Fed must be aware of them because Walmart's such a big, and Target's such big companies, those two factors probably have gotten the Fed thinking, my goodness, are we overdoing it here? Well, one of the things that would be interesting to know is, have we ever seen inventories, Target or Walmart, have their inventories ever increased this much? So Target's inventories, their unit sales were probably down. 3% was the dollar value, but in units, probably down. And their inventories were up 42%. So take away inflation, that's 30 to 35% on a year-over-year basis. I do not believe we've ever seen that before. And these are well-managed companies. And so what I think happened was human beings overruled their enterprise resource planning systems, their software, and they did double order and triple order. I know that Target said part of the disappointment in sales and earnings was they had to start marking down goods in order to start clearing shelves. And even with marking down in April, these are through April, their inventories were up 42%. Walmart's were up 33%. Home Depot's up 32%. So much for supply chain problems. I mean, those, at least in the case of those three companies, the supply chain issues are disappearing. And one last point on used cars in particular. I think a lot of people bought that extra car because they didn't want to take mass transit, and they saw prices go up, so they actually made some money on those early purchases. I wouldn't be surprised if they now that mass transit is open much more, they start selling into the used car market where used car sales are already down 20%. I wouldn't be surprised to see an implosion in those prices. We are also beginning to wonder if there's an accelerated shift now taking place to online, now that energy prices have soared. And because if you look at total online sales as a percent of retail sales, that number in the United States is 15%. In China, it's more like 45%. Normally, when you get a trend, a consumer trend moving through that 15% mark toward 20, it's a trend that's moving into overdrive. So those bricks and mortar retailers who enjoyed such a nice rally last year as people were going back to stores and so forth, they are probably now facing a day of reckoning. These energy prices are preventing trips to stores. And so we would not be surprised to see a lot of carnage in the retail sector. Again, we always say innovation solves problems. And in this case, consumers ordering goods from home is probably taking place at an accelerated rate.
If you enjoyed this video, make sure to leave a like, comment, and subscribe. We'll see you in the next video for more finance tips and up-to-date news.